let's welcome our guest. Joining us today on the show is Tanwir Alam, founder and CEO of Fincart.com. Thank you very much, Tanwir, for joining us on the show today. Lots of queries coming your way, but before that, one important question that I wanted to start off with in terms of how to creating wealth, and what is the secret sauce really that you have as far as wealth creation is concerned?
Okay, honestly speaking, there's only one secret sauce to wealth creation, and we have all learned that in our school. That's called power of compounding. So, and in the school that we have learned that formula, amount equals to P within bracket 1 plus R raised to the power n. That's the only secret sauce to wealth creation. Now, let me give an anecdotal number. 5 raised to the power 10 or 10 raised to the power 5, which number would be the bigger one? So if you compare, 5 raised to the power 10 would be a much bigger number than 10 raised to the power 5. It is the n, that is the time horizon, that plays like magic when it comes to longer time horizon of investment. Point number 2 is, power of compounding does not efficiently work for time horizon less than 5 years. So when it comes to investment and you have any goal that is maturing within the time frame of less than 5 years, the focus should be preserving wealth and not chasing return blindly. All you can aim at is trying to optimize the return, post-tax return, which should be better than a fixed deposit. Now, if you look at any funds, any equity funds that has completed a journey of 20 years. Now, I am not sharing any hypothetical data. I am actually mentioning about the exact wealth creation journey that has happened over a period of 20 years. Now, you pick up a fund, HDFC Top 200, Reliance Vision, or a Franklin Templeton Blue Chip Fund. Now, if you look at, even if you're investing just 10,000 rupees a month for a period of 10 years, you would invest only 12 lakh rupees. That 12 lakh rupees on 10 year would have been anywhere closer to 30 lakh rupees. But if you kept that money and kept investing 10,000 rupees every month for a period of 20 years, your own investment would be just approximately 24 lakh rupees. But that 24 lakh rupees would have created significant wealth. And that in today's time would be anywhere closer to 2.75 to even 3 crores of rupees. Now that is what is called wealth creation. And this simple formula, if somebody follows, nobody can stop people from becoming rich.
You make it sound absolutely easy, as simple as 1, 2, 3. But yes, the magic formula, as you said, takes us way back to school. The power of compounding is what you stressed upon. Thanks very much for giving us that very interesting assessment. Well, we've got a load of viewer queries as well for you, and our first query, interestingly, comes all the way from South Korea. So good to know that we're being watched world over. Vivek Raj has sent in this email query. Well, he says, can you explain the correlation between inflation trends and mutual fund trends? He says, aren't returns based on earnings and EPS growth versus the macros? And, this would be a common misconception, that why are we really mapping what goes on with inflation, what goes on with interest rates and the macro trends? And he wants to really understand what the correlation is between the two. But I assume that it holds a fair amount of importance when it comes to the fundamentals of the mutual funds.
Absolutely. See, a lot of the parameters that he spoke about are interlinked, like your inflation, earning growth, GDP, all are interlinked. So let me a little bit make it simple and make it more from his investment perspective, whether in equity and debt, how will this investment get affected? Now, if you are investing in a stock market runs on 2 key factors or parameters. One is the corporate earning that he has referred. If companies make profit, the share prices will go up. And the second factor that you are looking at is the liquidity, the amount of money chasing the stocks, and that goes up. So these are 2 key factors that drives the market overrun. Now, unfortunately, markets are never rational. There are moments of exuberance and there are moments of complete depression. So when there's an optimism around, you will see the markets running very rapidly high because that is the more money chasing it. When there is a pessimism, so you'll see all the bad news coming out of the woodwork, and everywhere there will be some amount of pessimism and bad news. So during that time, the money chasing the stock reduces substantially and the market gets undervalued. So to make my point very clear, let me use an anecdote or an example. Suppose stock, corporate earning and stock market, they are two friends and they are driving on a highway to go to another city. Now, for a moment, they assume that the stock market has driven fast and is moved a little bit ahead of corporate earning. Now, there is two things that can happen. Either the stock market, the corporate earning has to catch up, or the stock market will correct. So this is exactly what has happened in today's time. If you look at, the market has run up a little bit faster than the corporate earning in anticipation that the corporate earning will catch up. Now, for any reason, if the corporate earning do not catch up, you will see the market correcting.
Tanwir,
when it comes to inflation, sorry.
Sure, go ahead, go ahead.
Inflation will affect the bond part very clearly. When the inflation goes up, your interest rate in the economy keeps going up, and when interest rate goes up, all your bond funds gets negatively impacted, and you will see a negative return in bond funds also. So this is how inflation affects your bond fund and mutual fund trends.
Right, Tanvir, just a follow-up question to that. In terms of, very often inflation is sort of not taken into account when people plan their investments in terms of how much they would need if they have a certain goal of a certain amount of corpus, say 5 or 10 years down the line. They don't often take inflation into account. If you could just, reiterate the importance of taking inflation into your calculations as far as your financial planning is really concerned and your investments are really concerned.
Oh, fantastic. So let me give you a very simple thumb rule. Now, a lot of people understand the cost of living is going up, but at times it's very difficult to quantify that number, and hence the importance of that number gets diluted. So for example, I'll share a simple formula. This is called rule of 72. Means 72 divided by whatever inflation rate that you can think. Now suppose, assume that the medical inflation today is 12%. So 72 divided by 12 would mean that 72 divided by 12 is 6. So it means 6 years your medical cost will double. This rule of 72 is a rule, this is used for doubling the value. Now, if your medical, say a treatment is costing today 3 lakh rupees and inflation is 12%, it means after 6 years that same treatment will cost you 6 lakh rupees. Unfortunately, when you're investing, this demon is not visible to you. You tend to avoid that. You look at the pre-tax and pre-inflation return. FD is giving 6% return, 6.5% return. Now, if you subtract tax from that, it typically lands up between 4.5 to 5% depending upon your tax bracket. So 4.5 or 5% post-tax return is much lower than the average inflation that you do with 6 and 7 years. Now, you are under the impression that your money is growing. Unfortunately, it's actually decaying and degrowing. This inflation is like the termite, which may not be visible to your eyes from outside, but it is eating into your woodwork from inside. So this inflation is like the termite which is eating into your money from inside without you having knowing it.
That is the importance. So do remember, you should overall look at monitoring the macros as well. It is like a termite that could perhaps eat into your investments. And there was a very nice correlation as well that was explained by Tanwir as to how liquidity is fairly important and how the overall macroeconomic situation could affect mutual funds. Well, we're getting lots of live queries as well on the number flashing in on your screen. And I just want to remind our viewers, these are mutual fund queries, queries on insurance, queries on tax. We're ready to take all of that up, not queries on individual stocks. Next up, let's connect with Gopalan, who is with us, and he's got a query saying, can you elaborate on the ratings change for mutual funds? What is the rating and the outlook for the HDFC equity fund? Should I remain invested? And you know, I'd assume that anyone who puts their money into a mutual fund will automatically go online, see the rating, and then assess whether or not they should stay invested. Is this a good practice to use? And what exactly is your outlook on the HDFC equity fund, Tanvir? Tanvir, can you hear me? Okay, I think we have a bit of a problem. We're getting in lots of queries. We will be talking about the ratings change, what it means. For now, we take a break, but I want to remind all of our viewers that we have a Children's Day special that's going to be coming up on the 14th of November. Firoz Aziz of Anand Rathi will be joining in. Send us details on your portfolio of how you can save for your child. Any questions or queries that you would want to know, you can drop in an email on themoneyshow@etnow.tv. You can call us and send in your query there, or tweet out to us the A to Z of investing for children, for their future, for their education on the 14th of November, 5:30 p.m. themoneyshow@etnow.tv. That's the email ID where you send in your questions. Welcome back, still watching The Money Show, and if you've got any questions for investing for your child's future, please do send them in to us on The Money Show at etnow.tv. Right now, of course, we are in conversation with Tanwir Alam, founder and CEO of fincart.com. Tanwir, unfortunately, we got disconnected because we had a query coming in from Gopalan in Bangalore. I'm just going to revisit that question. He says, can you elaborate on the ratings change for mutual funds? What is the rating and your outlook for HDFC equity fund? Should I remain invested? And, you know, I was saying that generally when people put money into a mutual fund, they probably go on Google, just check out the ratings, and based on that, make their assessment. Is this a good practice? And what do you think of the HDFC equity fund?
See, I mean, this is one of the most common mistakes that people do while investing. Now, it's like looking at the rear view mirror and driving. So, only picking a fund based on the historical performance or a rating could be misleading. Now, what happens is a fund manager will have his own set of good and bad phases in the market. No one fund over a very long term period can be always in the top quartile or be number one. Even the best of fund managers have some subdued performance at times. What you look at is a good quality DNA of a fund house and then stay invested. Secondly, the historical return, for example, if you look at the historical return over last 1, 2, 3 years right now, some fund will be looking exceedingly good. And looking at the return, if you invest, you could get caught in the wrong foot. Because of the market corrects, they all give negative return. So the best would be to pick up a fund and judge its rating over a very long term period and match to your requirement. For example, if you have a very long term investment time horizon, then an equity fund serves your purpose. But if your requirement is for say 2 years, 3 years down the time, then equity funds can be very fatal. There could be only a 60-70% probability you will make money. So just don't pick a fund based on the rating or the immediate past return. Do a little bit more homework if you can and try to assess your requirement and then map the fund based on your requirement to avoid any casualty in your investments.
All right, well, let's go across to our next question then. It's coming in from Mitul Patel, who sent us an email saying, I started with 50,000 SIP in June 2015, then increased it to 1.5 lakhs in the last 2.5 years and added around 25 to 30 lakh as a lump sum. Currently, I'm investing 1.5 lakh through SIP in a few mutual funds. I want your expert views on my current investment portfolio to check whether I'm in the right direction or not. And Tanwir, among the funds that are in the portfolio is Axis Long-Term Equity Fund, Franklin India Tax Shield, Mirai Asset Great Consumer Fund, L&T India Value Fund, and Invesco India Tax Plan. What would be your advice as far as these particular funds specifically are concerned and on the overall portfolio?
In fact, I like his statement. He says, am I in the right direction? But he's failed to explain where is he going. Okay. Now, all his fund, if you look at, are all equity funds. Okay. So, if I look at, first let me compliment him in actually starting an SIP and also increasing the SIP amount. I think that's the only and a sure way of actually creating wealth. But having said that, I see that there are three major problems with the entire investment that he has done. First of all the funds are in equity funds, it lacks asset allocation. So if he has some goal which is for a very short term horizon of 2, 3, 4 years, then possibly he might have some problem if the market corrects. Two, the selection of funds are not very great. I mean, he got three of them are tax saving funds, one is consumer oriented fund, and one is the mid cap oriented fund. So, third and more importantly, if you look at his monthly SIP is of 1 lakh rupees per month, meaning 12 lakh in a tax saving fund, whereas the maximum limit for a individual in a particular year is 1.5 lakh rupees. So there is no point investing 12 lakh when your limit is only 1.5 lakh. And most often this 1.5 lakh limit gets covered by the PF that gets deducted by for corporate employees. So having said that, these are three basic problems that exist, and the worst problem is that he has taken ELSS which will get locked in for 3 years, and if you do SIP and an ELSS fund, your each installment gets locked for 3 years. So it's a very cumbersome exercise when he wants to get this money out also. So he needs to rejig his portfolio. The best would be to map his goal as short term, medium term and long term goals. For long term goals, he should look at equity fund, and he should look at large cap oriented, mid cap oriented equity fund if you wish to. For mid time, it could be a balance fund, and for a short time, it could be an liquid fund, arbitrage, or a short term fund that he could choose at this point of time.
Taken
Currently, his
note of
portfolio is
that
not very
advice
good
coming
quality.
in, exactly how you should be positioning your portfolio. But do remember, SIP is the best way to create wealth over time. Well, we've got some live callers as well. We've got Pradeep Kumar Sharma. He joins in from Kota, Rajasthan. Welcome to the show, Pradeep. What is your question?
Thank you, ma'am. My question is, I am investing in Reliance Pharma and Birla Banking and Financial, 5,000 and 10,000 rupees per month. Is my decision is correct? My view is 5 to 8 years.
Okay, let's find out if he should stay in these funds and if they're keepers. And I'm doing what you advised me not to do, actually, Tanvir, going and checking out the ratings. But they seem like decent funds. What is your advice on Reliance Pharma Fund and Aditya Birla Sun Life Banking and Financial?
See, basically, pharma in the last 1.5 years has taken a beating, but had a very fantastic runs over the last 3, 4 before this gap. Now, pharma is a one sector which has got undervalued as of now. So if he is doing SIP, I would say he must continue the SIP in the pharma sector funds, and his time horizon is fairly good for 8 years. So if you have a 8-10 year horizon, don't worry, continue the SIP on a pharma fund. Although we are not very bullish on any sectoral fund from an individual perspective, but sectoral funds come with a high degree of risk and high degree of return. The good part is that pharma sector is completely undervalued. If you are continuing SIP from a long time, you would have bought at the peak. Now it's a time to buy at the bottom level. So do not discontinue SIP, keep continuing it. So I would suggest to continue it. On the banking funds, again, the corporate banking sector has passed through a bad time. but now it's showing signs of recovery because of the resolution of NPA and problem which was plaguing the entire industry. I think here also I will advise you to continue your banking in funds and continue the SIP on for a long-term period if you have the time horizon.
All right, Pradeep, well, hope you've, thank you so much for calling in and hope you got the advice that Tanvir had for you. Well, Tanvir, thank you so much for answering all those queries. We'll have to wrap it up here. That's it from Avan and me. But a quick reminder for sending in all your questions as far as the Children's Day special is concerned on the 14th of November. Money Show brings you a very special Children's Day show where we will take up all queries related to investing for your child. So either call us, you can email us on themoneyshow@etnow.tv, or you can even connect with us on Facebook or Twitter and send in your questions and we'll have them answered by our expert Firoz Aziz.